Axis Equity ETFs Fund of Fund. Can this be a part of your portfolio? Who can invest in this fund? Who should avoid this fund? Let us explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take a right financial and investment decision so that you can meet your financial goals faster and smarter. Before evaluating or analyzing this fund, we have to understand some key features of this fund, and also we have to understand some important pointers on ETFs and how to select ETFs that will help us evaluate this fund of fund. Come, let us see. Axis Mutual Fund is the 7th largest mutual fund house. It is managing around 2.6 lakh crores of assets under management. This fund comes as a fund of fund. That means this is a mutual fund scheme. They will collect money from investors, and in turn they will invest in other mutual fund schemes. That is what known as fund of fund. Here they are going to invest in equity ETFs, equity exchange traded funds. That is why it is named as Axis Equity ETFs Fund of Fund. This fund is open till 18th February 2022, and the exit load for this fund is 1% if you are trying to withdraw before 15 days of your investments. If you are withdrawing it after 15 days, then there is no exit load. The primary objective of this fund is to invest in domestic equity ETFs and to generate long-term capital appreciation. This will eliminate the risk of security selection. What is meant by risk of security selection? When a fund, if it is an equity fund, when they are trying to invest or construct an equity portfolio, what will they do? They have to study different stocks in the index, and they have to pick and choose. At times, if their logic or their analysis goes wrong, whatever they chose may not do well. So this is a wrong security selection. This is the risk of security selection in actively managed funds. But they are going to invest in Axis Equity ETFs Fund of Fund in passive ETFs only. So passive ETFs or index funds, they will not do security analysis. They will not pick and choose a particular share. They will buy the entire index. So this fund eliminates the risk of security selection. When they are selecting index ETFs to invest, they will select funds which has got low tracking error. They are going to select passive index funds. In the passive index funds, they are going to do dynamic allocation. That means they will have large cap ETFs, they will have mid cap ETFs, they'll have small cap ETFs. So they can give allocation weightage to different ETF funds differently based on the outlook. If large cap outlook is good in their analysis, then they can go overweight in large cap ETF. If large cap outlook is not that good, they can reduce the exposure in large cap ETF. This way they can dynamically allocate the funds across the market cap. Not only with reference to market cap, they can also invest in sectoral ETFs. That way, based on the sectoral outlook, they can increase exposure to one particular sector, or they can reduce the exposure to particular sector by investing in a sectoral ETF or exiting from a sectoral ETF. As I told you, before analyzing or evaluating this fund, we have to understand some key pointers on ETF. What is an ETF? ETF is an exchange traded fund. Normal mutual fund schemes will be able to buy or sell from the respective mutual fund company itself. Whereas exchange traded fund, you will be buying and selling in the stock exchange. Most of the ETFs or index funds, they simply replicate or mirror the index in its portfolio. And passive investment strategy based investors, they prefer ETFs. People who don't want to take the risk of stock selection, people who are not willing to participate in active investment approach, they will go for passive investment approach. They will predominantly prefer passive ETFs because they have got a low expense ratio, a reasonable amount of diversification, and wide range of investment choices are available to them. How to pick the right ETF? There are many ETFs available in the market. How can I select? One important factors which are explained in these 3 bullet points are liquidity of the ETF. Rest of the mutual fund schemes, you are directly submitting your redemption request to the respective mutual fund company, and the mutual fund company pays the redemption immediately to you. Simple, right? So liquidity is available in the open-ended funds, equity funds. Whereas in the exchange-traded funds, you have to buy and sell in the exchange. A unit may be worth, a mutual fund unit may be worth 100 rupees. Because there is no buyers in the stock exchange, in the stock market for that particular ETF unit, it may be traded for 90 rupees. The actual worth is 100, but the trading price is 90. This gap is what known as impact cost in ETFs, and this impact cost is because of less liquidity of the ETFs. So what do you need to do is, you have to check the liquidity of the fund. How do you check the liquidity of the fund? Simple, you can check up the trade averages, volume. Trading volume is the best indicator of liquidity. And the gap between bid and spread. Bid and spread is nothing but the buyer's quoting price and the seller's quoting price. If there are huge gap between these 2 quotes, then it is having illiquidity problem. If the gap is very narrower or less, then in that case, that particular ETF has got good amount of liquidity in the market. An individual investor has to check this impact cost before investing. And another important point people who are investing in ETF has to pay attention is, they have to select funds which has got less tracking error. They are simply mimicking or replicating the index, so there should not be any tracking error. They have to exactly follow the index, so that tracking error counts. And generally select ETFs which are following broader index, not thematic or sectoral index, because generally in sectoral index ETFs there will be less buyers. In that case, liquidity can be low. So that is why, like, choose broad based index. We have understood the details of this particular NFO offer, plus some important pointers on ETFs we have understood. Now we can start analyzing this fund of fund. First, let us look at the pros, potential merits. Low cost, because they are going to invest in index funds, and compared to an active mutual fund portfolio, yeah, an index fund will have more transparent portfolio because they are going to simply mimic the index. And this particular fund, Axis Equity ETFs Fund of Fund, has got the potential to reduce the impact cost. Being a layman, being an ordinary investor, I may not be knowing much about the impact cost, trading volume. I may end up choosing an ETF which has got higher impact cost, which has got less liquidity. Then I will suffer, right? This fund is managed by a fund manager. He will check what is the trading volume, what is the gap between bid and ask spread. Then based on that, he will choose highly traded ETFs he will be selecting. That way, This fund can reduce the impact cost in your ETFs. As this particular fund is trying to select index funds which has got low tracking error, less tracking error, the minimal tracking error can be expected. This fund gives exposure to multiple equity ETFs in the market. They are not going to invest in one ETF, they are going to invest in multiple ETFs. This can be across capitalization, large, mid, and small. This can be across different sectors. And they are going to give allocation to different ETFs, different sectors, different market capitalization. And based on the outlook, they can change from large to mid, mid to small, from one sector to another sector. Based on the potential outlook, they can change. So here, the fund manager can add an alpha here. The fund manager will be able to generate additional return from this allocation weightage changing. We have looked at the pros, advantages. Now is the time to look at the drawbacks, potential demerits of this fund. Less potential for returns compared to active mutual funds. Active mutual funds can pick and choose best of the best stocks in an index and construct a portfolio. So they have better chances of generating return than an index fund. So that way, this fund has got less potential compared to an actively managed mutual fund. This fund simply selects stocks or simply selects the respective ETFs, and these index funds simply select stocks or simply replicate the index based on float adjusted market capitalization, because index is constructed based on this float adjusted market capitalization. The point here is there is no analysis done on the underlying stock. Nifty 50 is the index. If there is an ETF which is investing in Nifty 50, they will buy the entire Nifty 50, all the 50 stocks in the same weightage they will buy. Simple. They will simply mimic the index. They will not do any analysis on the outlook or performance, past track record of any of these 50 companies. They will never do. So here there is no calculated risk, there is a blind risk. Because this fund invests in index funds which are buying the entire market, entire index, they will not be able to beat the market. Market beating returns this fund may not give. Obviously, it is an equity ETF, so it is not suitable for short-term investments. The expense ratio, they claim that they can have low expense ratio, but as it is an NFO, it needs to be tested. We have to wait and see. And they also aim to reduce the impact cost. No, they have to check the liquidity and go ahead and invest. So how far they are able to reduce the impact cost is not tested. We have to wait and see because it is an NFO. How they are going to successfully move between one ETF to other ETF based on the outlook, from large cap to mid cap ETF, mid cap ETF to small cap ETF to a sectoral ETF. They can change based on the outlook, but they have to get the outlook correct and change it correctly. It should be productive for investors. If they make wrong calculation and they exit large cap ETF and give higher exposure to mid cap ETF, but in the market, what happens afterwards? Large cap ETF goes up, mid cap ETF's value comes down. Then in that case, the fund manager has taken the wrong call. Because of that, investors will not get reasonable return. So whatever the call the fund manager has taken has become counterproductive to investors. As I told you, all these abilities to successfully allocate, successfully reduce the impact cost, successfully have low expense ratio, we have to wait and see because there is no track record, because it is being an NFO. Now we have analyzed the complete pros and cons of this particular fund. Now is the time to understand, do we have to invest in this fund or do we have to avoid this fund? It depends upon what kind of investor are you. If you are a very conservative investor, not at all willing to invest in active funds, you don't want to take much risk, or you are selecting an active fund is not within your circle of competence, then in that case you can go for these kind of ETFs, fund of fund or ETFs. Even when you are going for these kind of index funds or index ETFs, better to go for an existing ETF, existing index fund with less expense ratio and less tracking error, because they have proved already. As far as this ETF is considered, we can wait for some more time. Access equity ETFs, fund of fund, we can wait for some more time and see their ability to successfully move between ETFs, ability to reduce the impact cost. All those things we can wait and see, and then we can decide. There is no need to rush and enter into this particular fund of fund NFO. Because this fund switches from one ETF to other ETFs based on outlook, and if the outlook is wrong and the fund manager ends up taking the wrong call, then this works against the basic, the passive investing principle, right? The basic purpose of index fund investing may get defeated. There's a high probability for that. The purpose of an investor going for index fund investing is predominantly he wants to avoid the fund manager risk. But this fund invests in index fund, but there is a fund manager who can move from one index fund to other index fund. So if there's a wrong call, then the investor suffers. That way this fund can be counterproductive also. If you are a very conservative investor and want to invest on an experimental basis, then you can try this fund with a minimum investment. We have completely given you an overview of this fund. If you have any further questions on this fund of fund investment option or any other investment option, feel free to book a free appointment with our financial planner. The link for the free appointment registration is given below this video in the description box. By the way, will you be interested to attend insightful investment webinars? Then in that case, we are offering regular free investment webinars. The link for the next investment webinar is given in the description box. In addition to the free appointment registration link, you can also register for the next free webinar. There are some interesting topics lined up. You'll definitely enjoy it. That can help you create wealth. In order to not miss any of our future videos, please subscribe to our YouTube channel. If you like this video, just give a thumbs up. If you think this video can add value to any of your friends or anyone in your social circle, please share it with them. Thank you. Bye.